Hi there everybody, this is Morris from San Jose Options, and today I want to talk about risk. I'm going to compare an Iron Condor to a low probability butterfly, and it's actually a rather interesting conversation. I'll point out the way I look at probability, and it's interesting to see that even though the Condor here has a much higher probability at expiration, well, as you're actually trading through the trade in live real time, you'll see that the trade actually has a similar probability to the butterfly. So it's very interesting once you consider your day-to-day probability compared to your expiration. They can be quite different. So hopefully this instructional video will open your eyes and help you see probability in a different light. So this is actually taken from our newsletter, and just thought I would make a video and explain some of the things in here. This way I could clarify. And also, that wasn't me, that was my chair, by the way. And also this is a good example of, why you might want to join our newsletter. We send out a lot of interesting information and hopefully helpful to you guys out there. So, so here we are looking at a high prob Iron Condor. And you'll see this one here has a probability of somewhere between 80 and 85%. So once you factor in the standard deviation, you're going to see between the circles here, these are the break evens, that this trade typically will be from 80 to 85% if you start the trade selling near the 10 delta. So that's how this trade is constructed. It's using, I believe I did it with a 10-point spread on either side, and I sold around the 10 delta. So if you look at this trade, this is taken from our software, SJ True, but if you build this in whatever software you're using, you'll see that it's somewhere around that range. Next, we're going to compare this butterfly, which is considered to have a much lower probability. You'll see that if you build this trade, I used the Russell in this case, so I'm really comparing the same exact underlying asset. And I sold this strike here at the money, and then I bought, I believe it was about 10% down and 10% up to build a butterfly spread. So for this type of trade, you buy one here, sell two here, and then buy one here. You can construct it a couple ways. You could do it with all calls, you could do it with all puts, or you could do it with puts and calls. The main thing that you want to notice is this one at expiration. Notice the green circles here. These are your break-even points at expiration. The red ones are actually your day-to-day break-even points. And so this is more narrow than the Condor. So if I go back up to the Condor, notice the shade of red right here, how narrow this is. This one's typically somewhere about 35 to 45% probability at expiration, where this one, again, you can see how the red shade here, it's so much wider. And again, you have the green is your expiration line, and this one again is a much higher probability trade at expiration. So that's the first thing we want to point out. But now we want to look at the trade as it progresses through time as you're actually trading it, because that's obviously extremely important, if not the most important part about it. So here we'll see that the realistic probability of the Condor is actually about 40% once you factor in a 10% loss. Okay, the red dashes indicate the loss area. So if you look here, this red dashed line, this is your day-to-day, your live profit or loss line. The green line here is where the trade ends up at expiration if you don't make any adjustments. Okay, so in this image, the red here is actually measuring about 10% down. So this up here measures about a 10% credit, and then you can see down here it lines up at this point, and this point is about 10% down the zero line. This is your zero line, by the way, the white line, in case you don't know. Okay, so once we match this up with a 10% loss to the downside or a 10% loss to the upside, you're looking about somewhere around a 40% probability once you consider that. So that's what's so interesting about this trade. You know, it has like 80 to 85, maybe even sometimes a 90% probability of profit at expiration, depending on what deltas you sell to start with. Okay. However, once you initiate the trade, your day-to-day probability is much more narrow once you start to factor in your actual losses and your actual risk. So most people, once they're about 10% down, they're going to start to feel a bit uncomfortable, nervous, stressful on this trade, because that's the most it'll ever make up here, okay, without applying adjustments. So once we're here, then again, if the underlying asset moves farther, now you start to lose more than you can make on this trade. So what I'm looking at here is this probability zone where the user, the trader, is going to feel comfortable in the trade. And so it's about 40% wide. Then when we come down to the low probability trade, this butterfly, it's interesting because your 10% down zone is actually a very similar width. Okay, so you can see that, if not a little wider, but it's pretty similar. So when you compare the two, you'll see that this one is pretty wide here, and then this one, it's a very similar width. And so they're both actually, even though this one has a more narrow probability expiration, they both have a very similar day-to-day probability range, about 40%, once you factor in all this risk. So that's the interesting thing about this conversation, and the thing that I just wanted to point out and have you understand, because a lot of traders may think that the Condor has a much higher probability, but in fact, your day-to-day is pretty similar. Then when you build a calendar spread, you're going to have, again, a very similar risk graph. So again, you'll have a trade here that, at expiration has about maybe 40% similar to this butterfly, 40% wide probability expiration. But again, as you're in the trade and you have your graph looks kind of like this, it's about the same. Okay, so that's about where your 10% really lines up, about here and here, almost the same as the final probability of the trade. Okay, and then to recap on that Condor there, even though expiration is wider, once you factor in your 10% drawdown, then you end up with almost the same probability. And so your day-to-day on this type of trade, even though one looks like this square or rectangle shape and this one's a triangle, it's actually a pretty similar trade. The Greeks can be a little bit different, okay, but similar. The butterfly has your negative vega. This one has your negative vega. The butterfly actually having both of these strikes closer to the money, they may have a higher theta, but they actually have a slower decay rate. So in the butterfly, your outside strikes are going to have a higher decay rate because they're farther out of the money. They're going to decay faster on you. This is going to have more theta, but actually it's decaying slower. So your Condor would actually have a higher overall decay rate because your short contracts are farther out of the money. So that's something to consider there. your calendar, this one here, you're selling in front month, buying farther out in time. And this one ideally seems like it would have a flatter Vega position, but it actually sort of has a more of an unstable Vega position because you're splitting 2 months and the 2 months are a little bit unpredictable. We do have tools in our software, SJ True, that can help you enter and exit trades to identify some opportunities with your volatility skews and things like that. But overall, you know, this one, it's not necessarily positive Vega like you may think, like this calendar trade here. So we do a lot of studies on these, and we just find that it's not exactly positive Vega like you might think. And actually, when volatility drops, oftentimes it hits the front month much harder, and that particular trade actually makes money oftentimes when volatility drops up. So even though your software may say it's positive Vega, it may actually react like a negative Vega trade. So just be aware of that. Okay. So anyway, all these trades have very similar probability. Your credit spread may look like this, and then you have a similar effect on one side. So you have that zone here where, you know, you're about 10% down, and again to the left side on this trade you would have that pretty narrow probability, but this one all the way one side has a higher probability. So, you know, one could argue that the credit may have a higher probability overall because of that, but, you know, others might argue that, you know, it brings in half the credit, and so it's also more directional because this one starts off with a very directional delta where the others have a flatter delta. So again, once you factor in some of those numbers, you know, it's hard to say if the credit spread is really higher probability or not, but, you know, you could argue that this one's more like 50% once you factor in, just because this side, you know, but to the left side, again, it's going to actually be worse because these ones start off with a flatter delta, so they have more room to the left. This one actually has less wiggle room to the left and then more to the right, so I don't know. It's hard to say, but the thing is, all of these trades actually have a pretty low day-to-day probability, and so it's very important when you're trading because you can't just look at your expiration here and here. If you just do that, then, I mean, obviously, you know, we're not made of steel here. We have emotions, we have real money on the line, and, you know, it's hard to just base everything on your expiration. So it's mostly, I'm talking about this situation here. So again, if you're working with your Condor, just be aware if you come into this trade, you know, believing in this, the 80 to 85% probability, sure, that's mathematical, but this zone here is very stressful, to say the least, and same with this zone. So this is your safe zone up here, and it's very narrow. Again, 35, 40%, something like that, the safe zone. So it's not as low stress and safe as a trade as you might think. It's basically the point I want to make here. So come down to the bottom part, and as you can see, the high probability Condor and the low probability Butterfly have a very similar short-term risk profile, and again, the same holds true for like the credit spread and the calendar. And the fact is, we trade in real time, not in the future, which makes the realistic probability, this day-to-day risk of those two trades, as well as the other ones that I demonstrated to you, they're all very similar. So I already kind of did this for you, but I mean, for homework, you could certainly look at calendars, diagonals, and credits and determine, for yourself, because everybody has their own risk appetite, what your safe zone is and what that probability is once you factor in, the area that you're willing to be in on the trade. For me, they're about 35 to 40% probability. Anyway, in our course, we teach a way to trade with a much higher probability where we can pretty much double your comfort zone, double your day-to-day probability, and, well, obviously that's going to translate to a longer-term probability, and it's a different way to trade where, again, your mathematical probability is matching your day-to-day, so it's really nice. And so if you're interested in learning more, you can click on this link. Again, this isn't our newsletter, but it goes right to the website, and schedule your personal demonstration. Okay. So I guess that's about it. With San Jose options, again, double your probability. We also have our software SJ True, working on this every day, and you really, if you're serious about option trading, you really need to see what it can do. We have, well, I'm not going to say anything. Just get yourself a demo, and I'll show you what it can do. You'll love the tools if you're a serious trader. Okay, the phone number is down here at the bottom, 1-800-862-2503. Give us a call for your live demonstration. And that's about it. All right. You guys have a good night, good day, whatever country you're in, and we'll talk to you soon.